Last week, I spoke to David Quan, another ASX YouTuber, and we covered the basics behind technical analysis and how I apply risk management strategies to that technical analysis. Now, this is part 2 of that conversation. If you want to watch part 1, click on that link in the corner there. And just a reminder to people that neither myself nor David are financial advisors. So please don't take this as financial advice. This is just for education and entertainment purposes only. We also cover quite a few stocks in this video today. So just a reminder that there is no recommendation to buy or sell any stocks that we talk about today. It's just the targets that we put in there are purely for educational purposes only. Without further ado, let's get started. If you find anything helpful, please hit that sub button.
So I think this would be a really good time to jump to talking a little bit more about identifying common traps. So, the renewable sector is extremely hot at the moment. So I thought we'll go through a few examples and then maybe and actually show us what are some of the things to look out for if you're a long-term investor. What are the things to look out for when you're a short-term investor? So sure. Vulcan's really hot. So maybe we could start off with something a little bit more popular. So
okay. Vulcan. Now, actually, what I'd be talking about, one of the first things to notice is this candle here. That's called a shooting star. That's particularly relevant. That particular candle where it shoots to the upside and comes back down is particularly relevant for Vulcan, or it should be in the near future. And you can actually, there it is again. Let me just close my moving averages. So with Vulcan, this one's particularly difficult to chart because we can tell this entire breakout is based on fundamentals or some form of news. Now, I personally haven't actually looked into Vulcan, but I can tell just by looking at it, there's a fundamental reason that this is launched like this. A stock doesn't just go from $2.80 to $9 on nothing, right? It can probably go from $2.80 to $3.50 on nothing based on just a technical breakout, but a rally like this is fundamentally driven. Now, the difference between fundamental and technical analysis is fundamentals tell you where a stock is valued, where it's priced at, and the technicals tell you how to get there. So with a breakout like this, I normally rely on historical information. So if I bring up something like the monthly chart, the weekly chart, and you can see it's a relatively new stock with not much history. It's existed since 2018. There are no horizontals to work with. There are no targets to work with. But what I'd be looking for on the daily chart in terms of technicals is this candle that I was talking about, the shooting star.
Is that last year?
This was September 20, yes.
Okay.
So that's the first sign of weakness, and it's usually done on high volumes. Now, the shooting star that's less significant is on news day. And you can tell, again, this was a news event. I can tell because of the size of the candle, the gap up, and what happened, right? This is just me with experience seeing what's happening with Vulcan, right? This isn't a traditional technical analysis-based move. This is moved on fundamentals in this case. So a shooting star on just pure technicals with no fundamental reason behind it. So for example, if Vulcan had a news day and then had a shooting star, far, far less significant than if it just occurred, let's say tomorrow, and there was no news announcement. So what we're waiting for is, first and foremost, is the round number, $10. $10 is a magnet, $1 is a magnet, and 10 cents is a magnet. So stocks that rally, well, let me give you an example. I think BRN is a really good one. That's something that most people would be familiar with.
Okay.
This is a psychological magnet. It's all these round numbers, the perfect round numbers. So we have $10 up here. And whilst it doesn't, $1, sorry. And whilst it doesn't get to $1, there's always a drive to get there. And in my experience, when a stock hits around 85 cents or 8.5 cents or $8.50, that kind of range, it usually pushes to that psychological level of 10 cents, $1, or $10. The reason behind it, I can't tell you the reason behind human psychology, the reason behind the push to get there. But it happens, and you'll see it repeatedly happen. So what I'd be looking for in Vulcan is that push to $10. And then
going close, right? So going close to
as close
$10.
to $10 as possible. if you're at your screens and you're seeing this rally to like $9.80, $9.70, I'd be looking for the first sign of weakness personally and just getting out. Now, that doesn't mean this can't shoot to $11 or $12 in, say, a few days' time, or even on the same day. What can happen is a hard rejection, and then people going, oh, hold on. No, the fundamentals are actually really good. Like, this should be roughly a $12 stock, and it'll have no problem swinging to the upside. So if I bring up something like the 1 hour chart.
So with technical analysis, would that be a lagging indicator of the pure fundamentals then? It'll catch up to the fundamentals, right?
100%. Fundamentals tell you what it's worth. If you're bright enough to value a company, technicals will show you how to get there. So whilst this isn't like, I know I said technical analysis isn't crystal balling, but we know based on human psychology, based on trading history, that if this were to hit $10, the likelihood of a pullback is very likely. It's, I'd say, in the ballpark of at least 75% likelihood. Now, I'm just pulling that number out of thin air based on my experience, but that is what I'd expect. 3/4 of the time, I'd be expecting a pullback very close to or at the $10 mark, or perhaps maybe $10.10 or something like that. And then what I'd be looking for, because this is such a sharp exponential move, nothing exponential lasts. It doesn't matter what stock you look at all. No rapid rise from $2 to $10 is going to last. Now, that's not to say that it can't get to $12 or it can't get to $20. The point is that at this level, particularly at $10, expect to see strong selling and resistance. Unless there was something, because I don't know anything about the stock fundamentally. You might. I'll give you an example of one of my most high conviction trades of last year.
Okay. Oh, here we go.
Afterpay. Afterpay, I beat myself up over not taking this trade almost daily because I was trying to trade options for this one, which would have made exponential gains for me. I think I missed out on 75 to 80 bags of profit on this one. So we got Afterpay here that rallied into a channel here, a very tight channel. Now, when a stock rallies without pulling back, it's strong. Now, you could look at it over here and say, but you're just hindsight trading. Well, not every chart setup is going to have something for you. So if I pull back Afterpay to this point in time, let's say this is the point in time for Afterpay, I don't have really any technicals to tell me where to buy or really where to sell, right? This isn't a developed chart. There isn't enough of a range or a pattern. I can see that it's heading up to the $100 mark slowly. That's about all I got on this chart. And if I start drawing trend lines, okay, great, it's in an upwards channel, but there's not much there. I can just see that there's a channel. So it's about waiting for chart development. And this is a big criticism for people who do or who see technical analysis. They go, you're just charting things from the past and you're just, hindsight trading. But really, the reality is with technical analysis, you also got to be patient, especially if you're midterm swing trading. It's about waiting for the chart setup because there's not always a trade to make, right? I can't open up any chart and go, that's a buy or that's a sell. It's like, that's not how it works. You got to wait for the position to come to you, or rather wait for the trade to come to you. So here's an example of what I saw in Afterpay, and I was tweeting about it, and I was eager to get in on this one. I saw the chart develop. I saw the range, and I said the moment it'll break this top trend line, I'll buy into it. I'll buy options for it, and I'll aim for $120. And the other thing we'll get into is Fibonacci's as well. So here's my justification for the 120 target. It was... So this move and aiming for the 1.382. For those of you who know Fibonacci, it's the 38.2, but it's extended in the opposite direction. And as you can see, it got there perfectly. So I missed out on a very, very big trade because I unfortunately couldn't get filled on this day. But this is an example, a prime example of a stock that rallies, doesn't do much of a pullback, and consolidates at the highs. And it sat sideways at this was all-time high, by the way. It sat around $98, $96. And I know so many people who looked at this chart and went, I don't want to buy it, it's too high. Whereas I'm looking at it, I'm going, God damn, I can't wait to make 20%. Or for my options trade, it was far more than 20% because I was doing a very short-term trade on this one. And
So that
there it
almost
is.
feels like a spring.
100%. It's like a springboard. And it is my favorite chart setup of all time. It's a rally into a consolidation at the highs. So waiting for the breakout for confirmation. There are different ways to do this. For a longer term trade, it would be buying at the support levels. But you can see it's so tight that really it's not worth buying at the lows here, because it's, these are just a few days of candles. This isn't like spread out. This isn't a massive chart set up over a few months or anything like that. It's a very tightly coiled within 1 month range. I think it's like 3 weeks range. And then it broke out. So for me, the best thing to do was to wait for the breakout. And it was on okay volumes. It was pretty good. It was higher than most. And then the following Monday, it rallied even harder. So that was a beautiful setup. And we're seeing it rally again. So that is the one chart pattern I look for, and it's the one that most people avoid because they don't want to buy the highs. And yet here I am loving every bit of it every time I see it.
So that's something that it worked out for you, right? Like, what are some of the more other common pitfalls that's basically an illusion?
Sure, and we can apply the same thing here and assume that it failed. What can happen is, let's assume this candle didn't exist, and then it just flopped and sold down. That's called a bull trap. And this is exactly why risk management is so important. I set stop losses because I know that psychologically, mentally, I will not want to sell, right? It's just, we're born with it, right? Some people have a difficult time selling stocks, especially when it goes against them. They see red and they hold on to it going, it'll be good a bit later on. For me, I set hard stops for my swing trades because I know that if I look at it, if I don't have a stop loss, I'll hold on to it. It's a habit. I've learned how to rectify it for myself, and that is purely just by putting stop losses. So this is a trap that people can fall for, is the bull trap, where they're convinced that it'll recover. What they tend to do, especially if they've identified that it's a breakout, they'll buy in around this range, and then they'll wait for it to drop here. And they've maximized their risk. They've just increased their risk substantially. Instead of having a tight stop loss, they widen it because they hope, which is a terrible thing to do if you're a trader, is to hope that it recovers. And then if it fails even further, the psychology can become, yeah, I'll wait for it to come back up to this level, the retest, and maybe I'll close it out here. But a lot of newer traders, when they see it recover, they won't sell out their losing position. They'll hope that it breaks to the upside. So you can see why psychology plays such a huge part in trading. It's, people don't know how to lose, and I can't emphasize that enough. It really is a problem with trading. Making money is easy, right? How often have you held a position that's winning and you're cheering every single time? What do you do what happens when you're in a losing position? Your mind's going a million times a second. What do I do? I'm losing money. What do I do? Where's my target? What do I do? It's hit that target. What do I do now? So psychology sucks, man. And it's the hardest thing to manage. But if you can trade as close to a robot as possible, if you're as zen as possible, you'll do well in the markets.
It's interesting you talk about how people buy on the way up, but then earlier in the session, I remember you saying that you personally buy at the retest. So you, as the candle comes closer to, is it the resistance or the support?
It becomes support. So this was no longer resistance. This is now support.
Okay, so support. So well, earlier in the session, you talked about kind of as the candle come back down to the support, as it rebounds, that's kind of your own, personal entry point.
Yeah, for this one specifically, I was watching it so closely that I wanted at the breakout, because it'd be roughly the same price as if it retested. Right. So this was a very specific situation where I wanted the breakout. It was a very specific trade. Okay. For your average, let's bring up anything. Let's say JB HiFi, for example. Now, here's an example, a perfect example of technicals and fundamentals working in tandem. Now, today JB HiFi released its financials, the half year. Yeah. And they did quite well. But the technical, sorry, the fundamentals, people bought in at $54. The support level was $53. Now, what happened, maybe if I bring up the 2-hour chart, it'll be a bit better. So people bought in on open, expecting it to rally. The fundamentals is what stopped it from going higher. And the reason I say that is because the stock fell through major support. At support, if one was to buy at $53.02, that would have been a perfect entry. Perfect entry. And then you would have got stopped out, right? But the fundamentals is what stopped the technicals from working as well. So, the market has said that this key level, this $53 key level, is no longer respected because they don't believe it's worth that price. So the fundamentals, I mean, I priced it this morning at, I think it was $49.60, so not too far away. So it gapped up quite a bit, got pushed down. If the fundamentals were so good that maybe institutions or other brokers valued it at, say, $60, this breakdown most likely would never have happened. This would have been a key support level. They would have went, this is cheap and this is my best entry. They would have piled in and driven this stock back to the upside, or at least held above $53. So this is a mix of fundamentals and technicals working in tandem. And what we have here is what I'd argue as the perfect short entry. So whilst I would have got stopped out by buying here, and I probably would have got stopped out somewhere around here, I also would have taken a short position here. So I don't hold biases in either direction. I just do what the market tells me. And the market tells me, if I was to tell a story about this stock, it would be that the market has rejected it above a key level of 53 on high volumes. And volume is key here. The market has pushed it down and it's swinging back up to a resistance level. It was support, now resistance. And I would expect a move back down. How it gets down, I'm not sure. But my risk management, and I don't hold a position in this stock because I actually wasn't watching it today, but if I was to hold a short, I would have a stop loss somewhere back up in range here, because there's no reason this stock should break a key level and head this high up unless it was really moving to $60. But at this point in time, broken a level, high volumes, market rejection, and we're looking at a retest, and this should sell down. I would say there's a very strong likelihood that this swings to the downside. It continues for the rest of the week to the downside.
Super interesting. Okay.
So you see how this isn't crystal balling. I'm not telling people that, hey, this is going to 60 or hey, this is going to 50. It's, here's my risk management plan based on psychology and market movements, right? I don't care if I'm right or wrong. If I'm wrong, I lose as little as possible. If I'm right, I make up that and then some, because my risk to reward is significantly better. Sorry, my reward is better than my risk every day of the week. So that's kind of what I want to highlight to people who are skeptical about technical analysis. This isn't crystal balling. This is risk management at its finest. For your audience, there'd be more, I'd say, mid to long term, right? So I would be looking at, for your audience, looking at commodities. Commodities trade so slowly. They give you so much opportunity to spot reversals. Here's an example of gold, right? This is a 6-year breakout. This is probably one of the greatest breakouts I've seen in a long time. I've been waiting for this for so long, back when I was trading it. And it was this breakout here, right? This is 6 years of data for gold to break out. And of course, you can see the response, the massive surge afterwards. So commodities are really good for long-term traders. You can, even if you caught this momentum like a month or two late, it doesn't matter. Gold was $1,500 after, what's that, June, July, August, September. So 3 months. If you missed it by 3 months, you've still got so much room left. Because breaking out of a 6-year trend, the longer the trend that you break out of, the longer the swing to the upside or downside will be. So you've got things like gold, you've got US oil, and you can see major trends when they break. Whether it's 6 months or 1 year, you can simply just have a look at trends that get broken, and you can go short positions on something like this. And there are just so many major trends
My
over such
God,
long periods of times.
this is
So
oil, isn't it?
yeah, this is oil. This is WTI, West Texas Intermediate. So yeah, play around. It's worth looking. I mean, you got little horizontals here. You can see massive breakdowns occurring, and this is all over long periods of time as well. So you can happily wait like 3 weeks and say, hey, is this actually still below the trend line? And oh, okay, great. Or still above a trend line, and you can just ride the position, because these commodities tend to rally for a lot longer than stocks do. And you can simply hop on a stock that has that momentum, that has that commodity. So here's US oil, for example, and you look at something like OSH, and at any point in time, you can see where it breaks out, key levels, gap fills. So there's a lot there.
What gap between $5 and $4? Is that just a day off?
This was a news announcement. So what happened? I actually don't know what happened on this particular day.
Okay.
It's either a news announcement or there was a massive crash in oil on this day. But basically, when you see a gap up, and this is, I guess, another technical piece of information that people would find really helpful, is the gap fill. So you can see that when a significant event occurs on the morning of the 9th of April, how you'd see this is there's a gap because during the auction in the morning, people were selling far more than they were buying. So that caused this monstrous gap of like nearly $1. So sold off, and a target usually is once you break above this level, it usually rallies towards the upside to fill this gap. This is another key horizontal. The bigger the gap, the better, the stronger the likelihood of filling that gap once it breaks to the upside. So you can see here, I was waiting and waiting and waiting for OSH, and it hit this level again, and it just there wasn't enough strength in it, so it consolidated, went sideways, and eventually it
Now it
broke
did.
out. Yeah, and now it did. So you look at STO, you look at WPL, you look at any of these stocks with their gap fills as well, and you can see just how much it tends to respect that level. So the gap was from this candle here, and you can see just how much it respects the level. And again, it's a rally into a sideways consolidation just below this horizontal, and it's about waiting for that breakout. So yeah, so and this is all based on the chart of oil, and oil's in a nice big sort of upswing, and it's a long-term upswing. So we also have this horizontal here, for example. So here's going to be a key level as well, and it looks like it's broken out of it. And it'd be interesting if it in the next maybe 2-3 weeks, if it's still above this trend line, then it might be worth considering taking a long position in oil stocks. So yeah.
Wow. Okay. It's so different to. Yeah, I mean, I'm used to like reading reports, P&L stuff, balance sheet stuff. This is a little bit a very different perspective, which is nice.
Right. Yeah, because when you think about it, Australia has so much production for things like iron ore. You got stocks like Fortescue going nuts because of iron ore, the price of iron ore, and we've got so many gold stocks. We've got a few silver stocks. We've got quite a lot of lithium companies as of late. And if you just look at the lithium price and you can see the long-term momentum. These things move slowly.
Yeah.
So it's worth paying attention to commodity prices. I think your long-term traders and your mid-term traders would absolutely love this kind of trading.
Yeah. For something like I might edit this part out. For something like lithium that's not readily accessible on TradingView, is it even? I don't think lithium prices is available on TradingView.
I'd have to look up that code because I don't pay attention to lithium stocks much, but I know there's things like LI exclamation mark. I can't remember the stock tickers off the top of my head because I don't pay attention to lithium. But I think there is maybe it's just an ETF, not the spot price. I'd have to come back to you on that one. I'm not too sure.
This is so to me it's mind blowing because understanding price action, understanding the charts. I'm not trained in that particular way to understand it. So then to me it's a little bit foreign, and it's kind of okay, understand. So there's a big part of psychology behind it. There is that kind of almost like artificially constructed respect at certain levels. Wow, I can understand why someone would get really obsessive over this, because this is like, it's kind of like poker in a way. Like
100% risk management. The best poker players in the world have the best risk management. They do the math in their head.
Yeah. Wow. Is there anything else you would like to cover before we wrap up?
I mean, I think that's it. We can go over some just charts, any charts you want, and we can just talk about the technicals. We can look at something if it's set up. I can, let's say, I can give you a longer term stock that I'm holding if that interests you. It was IFL. I have no idea what this company does, by the way. But what I'm looking at,
what's long term for you, by the way?
Long term for me is 6 months plus. Okay. This is more midterm actually, because I bought call options because they're nice and cheap. But I'd be looking for a gap fill.
Oh, I see.
And we've got horizontals here. Now you can see that it has wicked above it. IFL is not a stock that is a household name of any sort. It's kind of, even I don't know what it is or what it does, but all I care about is the chart.
Okay.
And what I'm looking for is a break to the upside, but I loved the momentum and action that was going on here. So I did get in a little early. So my risk management here was to get in on this bounce off this lows, because it kind of double bottomed here. So it didn't drop below. I'll just zoom in here. It was what I'd call a bear trap. So you got bull traps and then you have bear traps. And in this case, it sort of faked a sell down because you can see the volumes were rising here, and then it recovered. And then that's where I bought into this trend up here, because this is going to be a slow moving stock. So I'm not too phased about the fact that I didn't buy in like here or anything like that. This is a larger cap stock, so I'm happy to take on the risk because I'd be looking at now a stop loss of here, and I'll put that in blue. And my take profit target now is just under 429.
Right.
So that's what I'd be looking at, is a rally. I'd expect resistance here, maybe a pullback, and then some kind of movement and momentum to about $4.20 for this gap fill. So that's something that I'm holding at the moment. That's really the only one that I'd consider long-term, mid-term. So, I mean, we can open up any stocks that you got that you want to have a look at.
I think we... I think it'll be good to wrap up on a few larger cap stocks, like for example, A2.
And here's,
oh my gosh,
here is a perfect respect of the gap. And it's funny, you don't see this every day, is a gap, it gaps below the gap.
Oh my God.
This is, I mean, you don't normally see that kind of selling, right? With A2 milk,
would that be institutional selling to drive? Like,
for sure. The volumes here, that is 26 million shares of selling at $10. So do the math on that one. That's hundreds of millions of dollars going through.
Yeah, that's definitely institutional. Okay.
Yeah. So what we can do first and foremost is, because the stock has moved up and is coming off so hard, the first thing I would do is I'd look for the first bit of momentum where the stock rallied. So what I'd be looking for is the first time it really launched this move here. That's what I'd be looking for, is the base of where that happened. And that really does seem to be from the very bottom of the chart. Like, it just kept going nonstop. And that's where I'd start my Fibonacci level. So Fibonacci is really from top to bottom, and really it's the top of the movement that matters. A lot of people get that wrong, unfortunately, but it's the bottom of the movement. And in this case, it's a very rare instance where A2 milk kept its momentum the entire way. So we have from top to bottom, 61.8 is a target and 50%. Now, all this means is from bottom to top, the 50% Fibonacci is simply halfway between those 2 points. Or this is 38.2% from the top of the range, or 61.8% from the top. So that's all that is. And really, what we're seeing here is a bit of respect at the 50. And what we're also seeing is a massive psychological level of $10. It closed at $10.09 today, so I'll just zoom in on that one. And that is a nasty downtrend. So what I'd be looking for is, because it's around the 50, I'd be looking anywhere. I'd consider a position at maybe $10.05, so just above that that level, that key level of $10, and this horizontal here at 982. Now, in this situation, it's kind of unusual because we're at a key level. We've got 3 levels. We have a horizontal here at $9.80. We have a Fibonacci of 50%, and we have a massive psychological level at $10. It all lines up, but not perfectly. They're all within like a little bit of a range from each other. They're about 20 cents away from each other. So we've got, instead of a simple straight horizontal support level, we have more like a range that looks like this box.
Right.
So that's a range of support. Some stocks have that where it's not just a straight simple line. So the idea here is that when there's more support levels stacked together, in this case, we've got horizontal, key psychological level, and Fibonacci together. When those 3 are around the same point, more people, more subsets of people are seeing the same thing.
Right.
So we can tell this isn't a normal technical sell down. This is a fundamentally driven sell off. There is no way we go from a massive company like A2 Milk from $20 to $10 with monstrous gaps without it being fundamentally driven. So we can see that it attempted to sell off, but then it not instantly, but it recovered very quickly. So what that suggests is that there is interest at this stock above $10 and to keep it above $10. So when it gets to 10, again, when it gets to 10, provided the fundamentals don't say it's an $8 stock or a $6 stock, this should bounce pretty nicely. Again, risk management. We have a lot of people seeing the exact same thing. Now, what I do in rare situations like this is I'd have a position above $10. So it'd be something like $10.05, $10.07. I'd have partially my position here. My other position would be here at this horizontal at $9.85. And I would keep a very tight stop loss, maybe $9.70, something super tight. So I'm risking very little because this is a fundamentally driven swing down. And that's kind of concerning. But, you know, the last thing you want, the absolute last thing you want is another gap down like this to ruin you if you go long. Wow. But that's the risk you take on any trade. That's the risk. That's just the risk you have to take if you want to be a trader, is you risk those kinds of moves. So that's my justification for going long on A2 Milk. And look, very tight stops because this is trending down. This is a big downtrend. So we have 3 support levels, and that's it. That's risk management. If it fails, doesn't matter. Doesn't bother me the slightest. I can fail another 6 times and I'll still be okay with it.
Okay.
It's all about that risk management.
Good. I think it'd be really good if we could wrap up on a lithium stock from where we started. So let's go with Infinity Lithium, which is something that's part of the whole EV revolution.
INF, is it? Infinity? Yeah. Yep. Alrighty, first things first is look at the history. So when you don't see something up front, like any history behind it, to look at horizontals is always zoom out and look for key horizontals.
Other candles, they look wonky. Like, is that just because the volume isn't quite there?
So do you know what the market cap of this stock is?
I think it's about $71
million.
Okay,
so if it's 71 million at 23 cents, so just give me 1 second.
I didn't realize how small this is.
308 million shares. Okay, so I guess what this is once it hits the 10-cent level, it goes up in half-cent increments. So this looks more normal, right? Because 1 cent per tick, basically. Gotcha. This is a half cent per tick. Okay, so when you breach the 10-cent level, you tend to get stocks that look more like this because it's like moving 5 ticks instead of 1 tick, like you would under the 10-cent level. So that's the reason the candles tend to look like this. And if you have high shares on issue as well, they tend to look like this as well, because then you've got more volume to churn through and it's harder to push the stock higher.
Okay.
So if we look at, from a technical perspective, what we're looking at, it's probably easier if I bring up the weekly. And we can already see there's a nice horizontal level around here at 28 cents. So that would be an eventual target. I think price action and momentum, judging by the volumes, like this is beautiful. This is, seeing these volumes on these candles that are green is beautiful. Now, remember what I said, how volume is everything? If we look at where it starts to sell, it sort of dips a little bit, but nothing significant, right? So it's a few ticks. Look at the volume. Massive. Look at the volume of that selling. It's nothing. And then you've got another monstrous push to the upside. That is beautiful. Volume just tells the story. This looks healthy to about 28 cents quite comfortably. I couldn't say what time frame. By the looks of it, perhaps maybe a month and a half, perhaps.
Interesting.
It depends on, again, news and price action. But
this is very much about news. Like there's been a big push towards, obviously the EV evolution helps, but they also have government support from the EU. So there's a lot of news kind of supporting this movement, which is nice. We want renewable energy.
Sentiment. You want, ideally, you and I want to trade stocks that go on momentum and sentiment, right? If you have a stock that's trickling down, and A2 Milk is kind of one of those at the moment, it's trickling down, it's got poor sentiment, it's got bad news after bad news after bad news. I mean, that was an example of how to place a good entry, but it's not something I would personally take. It's just an example of how I'd split my entries and risk manage it. But I don't want to get in on a stock that is clearly in a downtrend. And this is something that I think a lot of people mistake, is they don't understand what's a pullback and what's a reversal.
Right.
So on a longer time frame, if we have trend lines, and we can see this from October 18, November 19, so that's a nice 1 year gap, to October again. So these are nice sort of 1 year increments here. So this is a pretty long-term support level.
Right.
And what do you see when it hits support? Is you get your initial bounce, but the fundamentals take over. The bounce is only temporary, goes through. I'm surprised there's a rally here. That's very unusual to see. But basically, we've broken trend, and it eventually goes back down under trend. And ideally, when trading a stock, a pullback is something you'd be interested in getting in on, not a breakdown. So when something is broken down like this, and it's clearly gone below major levels, it's hard to really enter a stock like this. And this is where I come back to that point that I mentioned earlier, is buy low, sell high, and how that's a toxic mantra. It's a terrible thing to try and bottom pick a stock without high quality risk management, which is, a lot of people will look at A2 Milk right now and go, I'll buy it, it's cheap. What they don't realize is they're buying into a massive downtrend. This isn't like a small downtrend either. This is monstrous selling. And they're trying to bottom pick something. But the likelihood of it going down is, I'd say, pretty high. Like, whilst this entry is justified, for me, it would only be justified with extremely tight stop losses, because it's factoring in the broader picture of the technicals, which is, this is just a massive downswing. I mean, you can just look at the monstrous volumes of selling that's occurred. And where are the buyers? They came in for a little bit of a bounce, but then they disappeared very quickly. So volume tells a story. Something like this, it is a perfect entry, perfect risk management, but ultimately the likelihood of success dwindles on something that's trending down. Ultimately, the odds of us picking this stock at $10 and actually being the bottom is extremely low. And that's why I said I have a tight stop loss. That was like a few cents stop loss. Because the reward is massive. If this is the very bottom and we pick it, that's massive. The risk to reward is beautiful. But if it goes against us, we lose a few cents. So what? It's like, great, we'll move on.
Right.
So, because I know a lot of your viewers and listeners, they're not going to have access to short selling. So
No, I
for
don't
me,
encourage it either. Don't encourage it either.
because if this goes below $9.80, that is a beautiful short, because it's just following this massive downswing. For me, this would be a gorgeous short. But will I still attempt a long? I mean, I'd consider it with tight stops.
So this will be a breakdown. What do you have an example of a like more of a traditional pullback?
Sure. Let's say I'd have to just start picking random stocks and having a look, so we can identify. The problem is with traditional pullbacks is we're in the space of COVID, so
Fair enough.
so
Let's
things
go
have
with,
gone.
Let's go with, like, for example, something like say Zoom.
Yeah. Okay. US stocks. Great. Okay. Brilliant. So this is something that here we have a longer term trend, and we're back in range. This was a bear trap, is what we'd call it, because this is a long-term trend, the longest one that we can identify. And a pullback would be on a longer time frame, would be around this level at 370.
Right.
Now, it'd be unfortunate for anyone that sold below or had an order and sold below, but this looks great, because what we're seeing now, whilst someone like myself would have got stopped out for sure around this level, entering at support, I would have got stopped out very tight. But at the same time, looking at this chart, volumes are coming in and we're back above the trend. So this is something I'd happily enter back into for a momentum swing. This is just on the real beginning view of Zoom. I'd have to look a bit more. Spot trends, great. It's broken trend. And this is the downtrend, by the way. This is the downtrend that caused the break of the bigger trend. So now what I'd be looking at is, great, if I entered, what are we seeing? We're seeing this break, right? This break above the bear trend, which is here. And the stop loss would probably be around here, around this 364 level. So it'll be an entry around here, above this bearish trend and above this bullish trend. And I'll just change that color so it's a little more obvious which one I'm talking about. So the pink line is the bull trend. The blue lines are the bearish trend. So you can see that on a long-term perspective, from a very long-term perspective, it broke down temporarily, but it's now back above it, and that's key. And it's back above it on high volumes. And this is a much shorter term resistance. So anything above both of these, it would be a fantastic entry with good stop loss discipline.
Would you say that in the most recent candle, that's a red bar? So
yep,
that's downward pressure.
Perfectly fine. But this is different to if I go to JB HiFi, where we saw the exact same thing. But the difference is we've got strong selling and it went under. So we have a break of major levels. It broke to the upside. So Zoom broke to if I perhaps bring up the 2-hour candles, be a bit more obvious. It broke to the upside and it stayed above these two major bull and bear trends, which is key. JB HiFi failed to hold the level. So this would be more like a short with a very tight stop because there's no reason JB should go back up. With Zoom, I'd be looking at an entry anywhere above the bearish trend and ideally above the bullish trend as well, the longer term bullish trend. So any entry around here is perfectly fine with a stop loss below these major levels. Now, how you define how far your stop loss goes is entirely up to you. In an ideal world, I'd be looking at buying as close as humanly possible to the bull trend. That's the one that matters most. Because if we can't really break back into the bear trend, it's not as significant as a longer term trend. So the longer term trend, the longer the time frame, the more significant it is. So we can see this longer term trend line goes a lot further than this short term trend. So that it's just more significant. But it should still adhere to technical analysis, should still be nice. The perfect risk to reward would be as close to this pink trend line as possible if you have the patience. And here's the thing. There's a chance that you can miss out. There's a chance that Zoom just goes whoop and rallies. That's just bad luck. For me personally, I'd be looking at a pullback to retest the trend line somewhere along here. And then I would have a stop loss just below it as well. So that would be the perfect entry, and it's something that I would risk missing out on for the perfect entry. So that's minimizing risk, maximizing reward.
I remember you saying that as the stock is compressed for a longer period of time, it won't break down as quickly as it goes on a rally. Would that apply to Zoom as well, in the sense that they have broken down in a few months and then they started recovering? That recovery process is pretty quickly. So then it might stay at this level for a long time then.
Yeah, there's potential for consolidation. The concern with consolidation above a trend line, so if I just delete this trend line here, there's a bit of a rule of thumb, and that's the longer you grind a longer trend line, the more likely it flips to the downside.
Oh.
Because there's no conviction, right? So if something comes down, it should bounce because there's conviction behind the buying pressure. So there's confidence in the market. If you've got something that kind of dwindles, the market as a whole tends to look at that as a weakness, unless something fundamentally pushes it. Purely from a technical perspective, that's a weak. So that should be a flip to the downside. So consolidation sideways here would not be ideal, especially because in the shorter time frame here. Now, if this probably might make more sense. You remember how my favorite setup was a rally. Sorry, let me bring up. So a rally into consolidation, into a tight range.
Yeah.
On longer time frames like this, because it goes over so many months, it may end up looking like that. Yeah. And then, of course, a dump into a sideways consolidation is just another dump. So it's the exact opposite. So
gotcha.
Rally, consolidate, rally. It's the exact same, but inverse. So that's why I would not want to see Zoom at a consolidation phase. This I would say must bounce when it comes back down to that key bullish trend line.
Interesting. Okay. I think this is a really good point to wrap up on our conversation on. Michael, thank you so much for your time. I really appreciate it.
No worries. Thank you for having me. Cheers.